I'm Eric Balchunas with Bloomberg Intelligence, Senior ETF Analyst, and I'm really excited today for this panel. We've got a look at the climate tech investment, and I can tell you from ETF flows and launches, this is a hot area and something that we're getting our heads around constantly. So this panel today is going to feature Jay Lipman of Ethic, Sean Kidney of Climate Bonds, Shaila Leekha of iClima, Dan Barry of SparkChange, and Sylvia Jablonski of Defiance. And so the first thing I think of when I think of tech investment or climate tech investment is, are we going after companies that are doing this kind of work in making, helping with the climate change and making a greener future, companies that would be in, say, a solar ETF? Or are we taking our portfolio and surgically removing the dirty companies so that we can, quote, sleep at night better? And I think that's the crossroads I think of as an immediate question. I just want to start there and get everybody's take on which of those paths do you take? And I'll throw it to Sean to start off.
Well, there's a negative and a positive. On the negative side, if you've got heft, if you're an institutional investor, your prime responsibility is first to engage and get them to change. We do need to really rapidly get out of fossil fuels. And let's get these companies thinking about different corporate strategies. And if they won't, then you divest. Personally, as an individual, hey, I've got an ethical position. I've removed all fossil fuels from my portfolio. I consider it the same as investing in landmines, or rather cluster landmines. And we need to be thinking about that kind of future. But the real job is to shift to green, massively grow what green is. The lack of opportunity at the moment, but let's do reverse inquiry. Say to everyone, give me more, give me more, give me more, because the only way we fix the planet is rapidly shift to large-scale green investments. And then there's a lot of opportunity.
Yeah, I would tend to agree. The science is clear. So we're at 56 gigatons of emissions today, and we have to reach half that target annually by 2030. The world is on board, regulators are on board, and consumers are increasingly aware and driving this trend. So what we see at iClima is this seismic shift. It's not a gentle sort of slow transition. It's a massive transformational shift that's occurring to a low carbon economy. And so what we think of is, what are the solution providers? So to your point, it's renewable energy assets. Yes, it's solar, but it's also sustainable agriculture. It's plant-based diets, it's electric vehicles, it's sustainable packaging. And what we look at are all those solution providers for two reasons. One, it's because what the world needs, and we measure their impact in terms of carbon avoidance. That's our metric. But second, we see these companies as the winners. These are the ones that are going to win in the long term because their solutions are what the world needs and increasingly what people are going to move towards.
Yeah, no, I agree with everyone's point, especially Shaila's point that, sustainable companies are not necessarily companies that are saving the world. They are companies that are just more responsibly run and positioned better for the long term, right? They're mitigating risks. They're investing in using less energy and having less lawsuits. But I think that, in order to have the kind of impact that we want to and need to have around these topics, we cannot be talking about billions of dollars transitioning into them, right? We need to be talking about trillions of dollars.
So we don't really think the Crossroads framework is a little bit too simplistic. If you have trillions of dollars of asset managers already committing to net zero aligned portfolios, etc. But if you did the analysis, perhaps only about 10% of the equity universe would be investable if you followed that sort of positive screening or negative screening framework. And all the money out there can't fit into such a small pocket. So the way we look at it is asset managers, asset owners should reallocate to the extent they're possible, that they're comfortable without destroying value.
90% of the world's energy consumption comes from fossil fuels, which are not renewable and they're essentially bad for the environment. We're talking about emissions control, and one way to reduce emissions is to focus on carbon, and you need an offset for that. So one of the offsets we believe is hydrogen, and hydrogen as a future energy source is a super interesting path to explore. So right now there's about a $200 billion investment in hydrogen. We think that by 2050, that'll look like an $11 trillion investment, and that 25% of the world's energy consumption will come from hydrogen.
Well, that was just a little taste of what you're going to see. And I also want to stress that what our goal is to really go over how to have a conversation with your clients about some of these ways to do this type of investment, the different ways to look at performance, the implementation, the differences between the indexes and how they're constructed, as well as different types of green investment like hydrogen, solar, wind, and the different asset classes in which you can use to do this. So you should come over to our panel. I guarantee you'll like it.